419 Mindsets of a Scammer. This is an educational project that teaches about numerous methods scammers, fraudsters use upon their victims, and also it helps to create public awareness of preventive measures that can be taken to protect themselves from being a victim of scammers. AwarenessX is your first line of defense against scams. What is Ponzi scheme scam? A Ponzi scheme is a type of investment scam that involves promising high returns to investors, typically with little to no risk involved. The scheme operates by using funds from new investors to pay returns to earlier investors, creating the illusion of a profitable venture. However, in reality, the returns being paid to earlier investors are not generated by legitimate business activities or profitable investments, but are rather funded by the contributions of new investors. The Ponzi scheme gets its name from Charles Ponzi, an Italian immigrant who became infamous for orchestrating one of the most well-known early examples of this type of fraud in the early 20th century. Ponzi schemes usually collapse when the scammer can no longer attract enough new investors to pay returns to earlier participants or when there is increased scrutiny from authorities. When the scheme collapses, many investors often lose their money, as the promised returns were not actually generated through legitimate means. Ponzi schemes share some common characteristics. Promised high returns. Scammers promise unusually high and consistent returns on investments, often much higher than what can be achieved through legitimate investment avenues. Consistent payouts. Early investors may receive the promised returns, encouraging them to reinvest or refer others to the scheme. Lack of transparency. Scammers provide limited information about the actual investment strategy or how the returns are generated. They may use technical-sounding jargon to confuse investors. Reliance on new investors. The scheme relies on a continuous influx of new investors to pay returns to earlier participants. No real business activity. The promised returns are not generated from legitimate business activities, investments, or profitable operations. Unsustainable. As the scheme grows and more payouts are owed, it becomes increasingly difficult to attract enough new investors to cover the promised returns. Types of Ponzi schemes. Scam Ponzi schemes come in various forms and can be disguised in many ways to deceive investors. While the basic structure of a Ponzi scheme remains the same, the scam can take on different appearances. Here are some common types of Ponzi scheme scams. Classic Ponzi scheme. This is the traditional form of a Ponzi scheme, where the scammer recruits investors by promising high returns on their investments. The returns are paid to earlier investors using funds from newer investors, creating the illusion of a profitable venture. The scam typically collapses when there are not enough new investors to pay returns to earlier participants. Real estate Ponzi scheme. In this variation, scammers promise investors high returns from real estate investments or development projects. They claim to have exclusive deals or access to lucrative real estate opportunities. In reality, they use new investors' money to pay earlier investors or to fund their personal expenses. Stock or Forex Ponzi scheme. Scammers may claim to be expert traders or have access to a special trading strategy that guarantees high returns in the stock market or foreign exchange (Forex) market. They attract investors by promising consistent profits, but they do not engage in legitimate trading and instead use new investments to pay earlier investors. Cryptocurrency Ponzi scheme. With the rise of cryptocurrencies, some scammers have created Ponzi schemes based on digital currencies. They promise investors substantial returns from investments in a specific cryptocurrency or blockchain project. These schemes often take advantage of the lack of regulation and oversight in the cryptocurrency space. Affinity Group Ponzi scheme. In this type of scheme, scammers target a specific community or group, often exploiting trust within that group. They may use religious or cultural affiliations to gain investors' confidence, making it more difficult for victims to suspect fraud. Advance fee Ponzi scheme. Scammers may claim that they can secure high returns for investors but require an upfront fee for their services, such as a membership fee, administrative fee, or tax payment. After collecting the fees, they disappear, and the promised returns never materialize. High Yield Investment Program, HYIP, Ponzi scheme. HYIPs often promise investors incredibly high daily or weekly returns on their investments. These programs typically involve some level of secrecy and may claim to be involved in various industries, such as offshore trading or private banking. In reality, they are fraudulent schemes. Non-existent product or service Ponzi scheme. Some Ponzi schemes claim to be involved in the sale of products or services, but in reality, these products or services do not exist. Investors are lured in with the promise of high returns from the sale of these non-existent goods or services. Pyramid scheme with Ponzi elements. While pyramid schemes are different from Ponzi schemes in structure, they may incorporate Ponzi elements by promising financial rewards for recruiting new participants. These recruits are encouraged to invest money, which is used to pay those higher up in the pyramid. How to avoid being a victim of Ponzi scheme scam. Avoiding becoming a victim of a Ponzi scheme or any investment scam requires vigilance, skepticism, and thorough research. Here are some steps you can take to protect yourself. Research the investment. Always conduct thorough research on any investment opportunity before committing your money. Look for official documentation, financial reports, and details about the investment strategy. Be wary of investments that promise extremely high returns with little to no risk. Verify the source. Research the individuals or companies offering the investment. Check if they are registered with relevant regulatory authorities and have a legitimate track record in the financial industry. Scammers often use fake names and credentials to appear credible. Understand the investment. Make sure you understand the investment strategy and how the promised returns are generated. Be cautious if the explanation is vague or overly complex. Question unrealistic returns. If an investment promises consistently high returns that are significantly higher than market norms, be skeptical. All investments carry some level of risk, and high returns usually come with higher risk. Avoid pressure to invest. Scammers often use high-pressure tactics to push you into making a quick decision. Legitimate investment opportunities allow you time to make informed decisions. If you're feeling rushed, take a step back and reconsider. Avoid relying on word of mouth. Just because a friend, family member, or colleague recommends an investment doesn't mean it's legitimate. Scammers often use referrals from trusted individuals to gain credibility. Be cautious of secrecy. If the investment opportunity is shrouded in secrecy and the details are not fully disclosed, be cautious. Legitimate investments should be transparent about their operations and strategy. Verify contact information. Check the contact information provided by the investment offer. Scammers might use fake addresses, phone numbers, or email addresses. Verify the legitimacy of the contact details. Check for licensing and regulation. Legitimate investment professionals and firms are typically registered with regulatory authorities. Check with these agencies to ensure the investment offer is legitimate. Seek professional advice. If you're unsure about an investment opportunity, consult with a licensed financial advisor or investment professional. They can provide you with expert advice and help you assess the legitimacy of the opportunity. Use caution with online opportunities. Be particularly cautious when dealing with investment opportunities presented solely through social media, email, or online advertisements. Scammers often use these platforms to target potential victims. Trust your instincts. If something feels too good to be true or if you're feeling uncomfortable about an investment offer, trust your instincts and walk away. Conclusion. Ponzi schemes are illegal in most jurisdictions because they defraud investors, distort financial markets, and ultimately cause financial harm to individuals who invest their hard-earned money. Investors are strongly encouraged to exercise caution and skepticism when presented with investment opportunities that seem too good to be true and to thoroughly research and verify the legitimacy of any investment opportunity before getting involved.